There seems to be an element of hesitation among stock market participants for US equity markets to advance higher. In this report, we are to discuss the effect of the release of January's US employment report, the Fed's decision and intentions, as well as upcoming releases and earning reports expected in the coming days, and for a rounder view, conclude with a technical analysis of the S&P 500. The main market mover of the past week may have been the release of the US employment report for January. The release shook the markets as, despite consensus for an easing of the tightening of the US employment market, the actual rates and figures highlighted its resilience. The release as such tends to allow more leeway for the Fed to maintain rates high for a longer period, as one part of its mandate, promoting employment, is covered and forces the bank's focus on bringing inflation down to its 2% target. Furthermore, the release tends to underscore the narrative of the bank for a possible soft landing of the US economy. Market-wise, the release obliged the market to reposition itself, yet US stock markets were able to overcome the obstacle and edge higher for the day. On the monetary front, we note that the Fed remained on hold as was widely expected. In its accompanying statement, the bank seems to be taking its time regarding the possibility of any rate cuts. The market currently seems to expect the bank to deliver 5 rate cuts until the year has ended. We tend to be even less dovish and suspect that the bank may start cutting rates in the summer and deliver 3 to 4 rate cuts in the current year. Overall, we tend to note that Fed policymakers are expected to continue making statements that could at least partially contradict market sentiment regarding the bank's intentions, which may weigh on US stock markets. Should such a scenario start emerging, it would imply that tight financial conditions in the US economy are to maintain for longer, which in turn may shrink revenue and profitability margins. The earnings season is still on, and headlines about earnings and revenue of various companies are still exciting traders. We make a start today with Alibaba and highlight Walt Disney. Other US companies to watch out for in the coming days could be Philip Morris tomorrow, on Friday PepsiCo, and next Tuesday Airbnb and Coca-Cola. On a more fundamental level, we note the release of the US CPI rates for January next Tuesday. Should the rates slow down beyond market expectations, we may see market anticipation for the Fed to start cutting rates early being enhanced, and those boost the buying interest in US stock markets. S&P 500 rose 4 weeks in a row, yet for the time being, bull seems to have hit a ceiling at the 4,975 resistance line, and the index shows some stabilization since the start of the week. We tend to maintain our bullish outlook for S&P 500, given that the upwards trend line guiding the index since the 27th of October last year remains intact. Please note that the 100, 200, and 20 moving averages maintain an upward slope supporting the bullish outlook. Also, despite the price action nearing the upper Bollinger Band, there is still some room to play for the bulls. Furthermore, we note that the RSI indicator below our daily chart remains near the reading of 70, implying a strong bullish sentiment on behalf of the market, yet at the same time may also imply that the index is nearing overbought levels and may be ripe for a correction lower. Should the bulls maintain control over the index, we may see it breaking the 4,975 resistance line, which is a record high level for the index, and we set the next possible target for the bulls at the 5,100 resistance level. On the flip side, for a bearish outlook, we would require the index's price action to initially break the pre-mentioned upward trend line in a first signal of an interruption of the upwards motion and continue to break the 4,840 support line and thus start paving the way for the 4,660 support level. Those were the top financial stories for this hour. We are here to keep you informed. From all of us here at IronFX, we wish you a solid trading.